Welcome everyone to the Rosecut webinar, the first of its retirement planning series. And today the topic is a deep dive on ISA and related other tax wrappers. My name is Chao Jia, or Q for short, as a co-founder and CEO of Rosecut. And today here with me is our portfolio manager, Daniel Greenhow. And welcome, Daniel.
Hi, Q. Thank you for the introduction.
So I've been asked a lot of times by our clients, as a digital proposition, does it mean there is an algo managing my money? The answer is no. Your money is managed by a human, and you're looking 2 out of the 3 humans right here. So I think the term, robot advisor can be misleading because there's no robot and there's no advice for most of the businesses. So there's risk warning before we go into the content, and basically saying there is risk involved in investing your money. Your value of the investment can go up and down, and past performance does not indicate future. So this is standard for people to be aware that there is a risk involved in investing. But we can also talk about how there's risk involved in not investing, such as inflation eating away the value of your money over time. So here, it's a snapshot of our platform, which is built for people to do the long-term strategic planning for their personal finances. And we say this is really important because a lot of people want to retire early. Well, you have to earn it. And the way is that not just having a high income or not having just a high saving ratio, you actually need to put that money to work and have enough assets that's working for you that can generate enough passive income so you can afford to stop working as an employee or as an entrepreneur or whatever that you usually earn your living. So there's a lot of financial vitals, as we talked about in the previous sessions, that you should care about, such as your debt ratio and your liquidity ratio. I will leave it to you guys to explore after the webinar on our platform at rosecut.com. So here, we show you a few more screenshots to show to see that for you to achieve your long-term financial future, you need to understand where you are today. That is your total net worth of today. And with the expected income and saving and investment, what is your long-term potential assets level? And by which time, which year, what level of assets you can afford to retire. One thing I would just quickly add here is that a lot of people will be surprised at the asset level they can accumulate, in 20, 30 years time. People usually just think that, I need a lump sum money, like inheritance or exit of my business, that's going to make me rich, and, have a comfortable financial life. That's only half of the job. The second half of the job is that you actually need to manage the money properly and to make sure it lasts. And you actually don't need a large lump sum money to get there either. You can have monthly savings, yearly savings that gradually build up your asset pool that gets you to retirement. So our platform is available on both desktop as well as mobile app, Android and iPhone. So please have a play and let us know what you think of that. So hand over to Daniel now to talk about, the different tax wrappers and what we need to know in 2020 based on all the ever-changing rules.
Great, thanks, Q. And it's worth highlighting those screenshots that you just showed there. Anyone can go in and have a play around with our platform at no cost. So go ahead and have a play around, see what assumptions we're using in there. It's a useful tool to have. Now, turning to retirement accounts and the sort of tax efficient wrappers that we see people using. What we've got here in front of you is pensions on the left-hand side and ISAs on the right-hand side. Now, in terms of pensions, we're not going to go through them in detail today because it's a big subject and we'd have to cover off things like the lifetime allowance, annual allowance, etc. What I will say is that with pensions, be they a SIP or a workplace pension, the tax benefits that you see there tend to come at the start. So in other words, you can claim some income tax back. And that's really useful when you're using it as a retirement account, because it means that you have a bigger sum of money at the start and it's got a long time to compound. And that helps you by the time you hit retirement. The drawback of pensions tends to be that they're a bit less flexible than ISA accounts. So typically you can't access your pension money until you turn 55, although that age is changing soon, as we'll touch upon later in the webinar. Now on the right-hand side, we've got the various types of ISA accounts. I'm not going to go through every one in this session because, frankly, most of the AUM that you see within the UK, so the assets under management, sorry, is invested into cash ISAs or stocks and shares ISAs, the top two. The other ones are kind of new ISAs. If you are interested in them, I would advise you to speak to a financial advisor and look into them in detail. Give us a call and we can point you in the direction of some research there, which might help you in terms of making decisions on them.
So
but as I say,
Daniel, basically, sorry. I think the situation or the choices between SIP and ISA many people ask about is that a SIP you do get more upfront tax benefit in the format of the government actually pay you back the tax you paid that year, but it's basically a lockdown of the money until you age 55 or 58 that you're going to talk about later. But ISA you won't get the upfront, but you don't pay anything in other sorts of tax once the money is in the ISA account, right? So a lot of people are sort of weighing out what's the best way to do it. But here is a good overview of the different things you can have, which, as I mentioned in our newsletter, a lot of British people are very familiar with this kind of schemes, and they kind of grew up knowing this, and with the a junior ISA given by the parents, for example. But non-British people like, new expats or, graduates of business school gangs like you guys here, they are not really familiar with. And it's a pity because you let go a lot of good tax benefit given by the government. And hence, we are here to tell you, these are the things you could start doing tomorrow.
Yeah, absolutely. These ISA accounts, they're really very helpful because they help shield returns on your portfolio. So, take it from me as a portfolio manager, I know how difficult it can be to generate additional returns for people. If you do generate them, you don't want to give it all back to a tax man if you can help avoid that. Just touching back upon the pension versus the ISA debate, it's not a case of one or the other. They are often very useful when they're used alongside each other. In terms of how you're going to allocate between the two, that's usually quite an in-depth thought process you've got to go through there. We have recently posted on our website an article that goes into a bit more technical detail on pensions versus ISAs. So that goes through a few numbers, and it was motivated by the fact that we launched our ISA proposition to clients within the last month or two. So this means that you can now hold a Rosecut investment portfolio within an ISA wrapper. I'd also just add quickly on that as well. The reason that ISAs are now something we're talking about as part of a retirement strategy is because historically, the ISA allowance wasn't an awful lot. When I started in the industry about 12 years ago, the ISA allowance was about £7,000. So even if you opened an ISA every year and contributed the full amount, it was never going to be a very big pot. But now, as we're going to touch upon here, the maximum you can contribute in 1 year is 20,000. So you can actually start accumulating a significant pot of money. That leads me on to cash ISAs, which is the first type we're going to talk through. As I just mentioned, the maximum you can contribute in 1 year is £20,000. Once the new tax year starts on the 6th of April, You can open a new ISA account and put in another £20,000. So you then have 40,000 plus any return that you generate on that cash. And that's how people build up these ISA pots over time. Some other rules just to go through. ISAs are only available to UK tax residents of a certain age. You can only open one ISA each year. Now you can have, of that £20,000 allowance, you could put half in a cash ISA and half in a stocks and shares ISA, but you can't have two cash ISAs in the same tax year. It's a government rule that says you can only have one of each type in a tax year. The key benefit to a cash ISA is that any interest generated on your savings account is tax-free. And that's, historically been what's driven a lot of interest in this area. Now, as we go on to the next page, what we've done here on the left-hand side is we did a search of a market last week. We looked at what the best cash ISA rates were. We found one that was giving 1.2% a year on the condition that you lock your money up for a year, which isn't always that appealing because it means you can't access it as and when you need without giving up benefits. But nonetheless, this is the best rate that we could find at that time. And we've just put on a line chart there how £100,000 of initial investment would grow over time. Now, on the right-hand side, what I've done here is take a screenshot from a recent paper or report from Her Majesty's Revenues and Customs, aka the Taxman. And every year they do a report into the ISA market and comment on general trends. And this bit that I've taken a screenshot of really is quite interesting because it points out that everybody has a personal savings allowance. If you're a basic rate taxpayer, you get £1,000 allowance. If you're a high rate taxpayer, that drops to £500. If you're additional rate, you lose it altogether. But the point here is, if you're a high rate taxpayer with a £500 allowance and you invest £20,000 in a cash ISA yielding 1.2%, then you're getting a return of £240, which is within that £500 allowance, which kind of makes the tax benefits kind of redundant. And that's really what we've highlighted here, and it's what HMRC said. As you can see, they said the incentive to invest tax-free is diminished for some savers. So basically, there's a lot of people out there that still have these cash ISAs, and for some people that will be appropriate given their situation. But it's worth raising awareness that the returns are not what they were a few years ago when interest rates were much higher.
And adding to that, the interest rate 1.2 per here that we displayed is before fees. So a lot of the cash ISA providers will charge you additional annual fee of keeping your account. Sometimes up to 0.5% or 1%. That wipes out, additional part of your interest rate. And so that's why there's a lot of complaint these days of saying that cash ISA is not worth the effort. The Rosecut view here is that we should always have emergency cash set aside. That is typically at least 3 months of your living expenses. So for example, if you spend on average 4,000 a month, then you should set aside at least 12,000 aside, not invested, but just for the cushion as emergency cash for any big last minute spendings and things like that. Now, if you can stick that 12,000 into a cash ISA and earn a little bit of return, that's great. But anything more than that, especially if it's more than a year of living expense, that's inefficient. As we were talking about, you holding cash with very little return on that, it just means that your purchasing power is eating away by the inflation rate. And by the way, typically about 1.2% every year. So this is one thing worth pointing out in addition to the very limited interest rate here.
Yeah. So turning to the stocks and shares ISA, which is the one that we're mainly interested in here because that's what we deal with primarily. The similarities are that you have the same allowance as a cash ISA. So you have that £20,000 a year that you can use. You can only use it in total. So you can't have 20,000 in a cash ISA and 20,000 in stocks and shares one. That's not how it works. It's 20,000 altogether. If we go back a couple of slides, Q, to that stocks and shares ISA.
Yeah, sorry. No.
And also, the other thing to mention on a stocks and shares ISA is that the name is a little bit misleading. It was traditionally called a stocks and shares ISA, so we still go with that. But in reality, you can hold a variety of asset classes within there. You can hold bonds, be they corporate or government bonds. You can hold direct shares. You can hold funds. You can hold exchange traded funds, which is what we hold within the Rosecut portfolios, which means that we can make the Rosecut portfolio a lot more tax efficient if a client wants to use an ISA account to hold those ETFs within their portfolio in there. As mentioned, but I'll reiterate, the tax efficiency with a stocks and shares ISA is that basically all the income you generate on your investments is tax-free, so long as you're not investing in something like direct US listed stuff, which we don't do. But any of the ETFs that we hold, they would be eligible to generate tax-free income. And also, when you're holding a portfolio, you're expecting to generate some sort of capital return. And you get an allowance every year in terms of how much capital gains tax you can incur before you're actually taxed. But when you've got a decent sized portfolio and you're sitting on big gains, it's easy to go over that allowance. So for stocks and shares ISA to make all those capital gains tax-free, it's a great advantage. And finally, another important point is we don't believe in charging more for this. So if you already have a general taxable portfolio, we're not going to charge you more by putting an ISA wrapper around it, making it tax-free. That doesn't make any sense to me. I don't see why we would penalize clients for being more tax efficient with their investments. And this is different to some other providers. I've been looking around the market and some people do actually charge more if their clients are holding an ISA, which is kind of bizarre, but it is what it is. So on the cash ISA, we showed you a projection. We'll do the same with the stocks and shares ISA. So if we just go to the next slide, please, Q. So this is a screenshot of our platform again. And what we've done here is we've taken an initial investment of £100,000, no additional monthly investment, just that initial lump sum. And we've shown how it would grow with a Rosecut's balanced portfolio. Now, there's bound to be a compliance person listening to this, or either in real time or to the recording. Hello to you. I'm sure they would appreciate me explaining some of the assumptions that go into our projections. First of all, the rate that we project the portfolios to grow is actually quite conservative. So for example, with a balanced portfolio, after fees, we're looking at a projection of about 3.1% a year. And that number is lower than you would have historically got, to be honest. And that's really because government bonds and corporate bonds do not yield what they did a number of years ago. So the expected return on a portfolio has come down, whatever risk level you're at, really. Secondly, we like to be conservative. We don't want to be one of these firms that overpromises and underdelivers. So, you know, if we can put a more conservative number in there, we tend to do so. Nonetheless, though, you can see how a portfolio would potentially grow over time. One thing we can't reflect in these projections is the volatility of a portfolio compared to a cash investment. In finance, there's just no such thing as a free lunch. So if you're investing in a defensive, a balanced or a growth portfolio, you should expect to see some volatility, and the higher up the risk spectrum you go, the more volatility you would expect to see. So I hope that makes the compliance guys happy when they listen back to it. On to the next slide, please, Q. In terms of how you can use these different accounts to create a retirement strategy. First of all, it sounds a bit like a disclaimer, but it's a really important point. Everyone has a different set of circumstances, so everybody needs a different type of strategy. All we're trying to do here is give you an idea of what options are available to you. Secondly, on the pensions and ISA slide I mentioned is a state pension, which if people have made sufficient national insurance contributions to over their lifetime, they will be eligible for a state pension. It's not the biggest sum in the world, but it's a start. On top of that, the government has really been trying to encourage people to put their own provisions in place for retirement. And as part of this strategy, they introduced the concept of an auto-enrollment pension. And this means that most employers in the UK have to create some sort of pension scheme for their workers, and workers are automatically entered into that scheme unless they deliberately opt out. So most people will have a state pension and then an auto-enrollment pension. They may also do a self-invested personal pension, which we refer to as a SIP for brevity. And again, we will do another webinar to go over those in more detail at a later date. The stocks and shares ISAs are a useful supplement to pensions. The advantage of the ISA is that you have more flexibility. You don't have to wait until you're 55 before you can access the money. You can take money out of an ISA at any point. Now, you can't just put it back in. It's not a current account. You will lose the tax wrapper benefits if you take the money out, but it is available there at any time if you need to access it. And this is especially useful if you're an entrepreneur or you're self-employed, because even with the best laid plans, sometimes you need a bit of cash to get you through the next month or two, and that's where pension, for the benefits, you don't have that ability to take some money out to help you, whereas with an ISA, you do have that flexibility. Also, for those of you that are internationally mobile, that flexibility is super useful as well. You might come to the UK and you might open an ISA, and then you have a change of heart in a year or two's time, you decide to go abroad. It's easy, you just close the ISA down. You can take your money out at any time, so there's no disadvantage there.
Yeah, to that point, it's actually quite important. 30 years ago, people work for the same company upon graduation until they retire. Everything is really stable. But I would say majority of the Rosecut clients, we would classify them as internationally mobile, right? So they could be born in country A and come to UK to study, or went to another country to study, that's country B, and now move to UK to work. Before you know it, before you turn 40, you've already have wandered around multiple countries and had to deal with multiple countries' tax jurisdiction. And more importantly, a lot of them are in international job posts. They could be sent to a country they haven't thought about even just 2 months ago. So we have a lot of clients who are like that, and to them, to go into a different country in a couple of years' time and not knowing where they're going to be retiring in 20 years' time means they're really reluctant to commit the capital into some lockdown pot until age 55, right? So to them, actually, ISA is the first choice because even if you leave UK, you can still keep the account if you wish to do so. You cannot, top up as a non-UK tax resident, but you can keep the money there. Keep it, under professional management and let it grow, or you can take it out as a down payment for your property in the new country, or do something else with it, like starting your own business. So I think this flexibility carries a lot of value. Even you get more upfront sort of tax rebate from the government on pension wrappers. So again, it goes back to the personal circumstances. If some of our audiences are the type that's international mobile, I know some of you are, and this is actually a really good way to save on the tax on the capital gain once the money is invested, and keeping it flexible and keeping it accessible. And by the way, just to jump in, we have already received quite a few questions, and feel free to ask questions along the way, and so we can answer them in one go after we finish the presentation in about another couple of minutes time.
Okay, so I guess one of the questions that we do sometimes get asked is, why now? Should I start saving into an ISA now? And part of our answer really looks at the likely direction of government policy. And if you think about what's happened just this year with COVID-19 and the amount of stimulus packages that governments have had to do, the furlough schemes, for example, that's quite an expensive thing to pay for. And so the governments are going to be looking for ways to budget for this, basically. And on the next slide, what we've got is a snapshot of a few headlines that we've seen in the press lately. So one of them, on the top left-hand side, the minimum age for pensions in the UK is actually going to rise from 55 to 57. So it means you can't access your money as early as you used to be able to. That change comes in 2028. So that's a confirmed change. The other three are speculation. So nothing's confirmed yet. It's just that there's been a lot of people looking at ways the government could raise more money. And one one option that's been bandied about is changing the capital gains tax rules. So, there's a quote in there from a partner at solicitors there saying capital gains tax is generously low at just 20% for higher and additional rate taxpayers. Now, if they do increase the rate that you pay on capital gains, this would again increase the attractiveness of using an ISA wrapper to wrap around your investments to shield them from that tax. And it wouldn't surprise me if some people are thinking about doing that with existing investments already, just to head off that risk. There's also talk about the pension triple lock coming back into the spotlight. I suspect we don't have that many retirees on here given our usual client base, but that's another option that the government might look at, because that was something that was introduced relatively recently, and I think it's been a bit more expensive than they realized. We can go into detail with that if anyone is particularly interested, but it's probably not as relevant to this audience, to be honest. In terms of the other reason why now, well, first of all, there's the market view, which is more like my home territory, so I'm glad we've gone to this section. But also, there are what I would describe as good financial habits that we see from our clients. And one of those habits is the habit of funding or starting your ISA account as early in the tax year as possible. And the reason this is a good habit is simply because it gives your investments more time to compound, and you're not scrambling around at the end of a tax year trying to remember if you've done your ISA allowance or not. There's no need to risk losing it if you are interested in using it. So it's definitely, if you can, it's best to do it as early as possible. In terms of the market outlook, how we're positioning portfolios, as anyone who's listened to our market updates will know, we were very optimistic on markets at the end of March. If you remember, around the end of March, we'd suffered quite a big drawdown that was linked to the coronavirus-inspired lockdown and the economic concerns that existed. At that point, we went overweight equities within portfolios because we thought there was good value there and it would generate a high return for our clients. That's worked out nicely. Since then, we've turned a bit more cautious, but we're not defensive. We're still invested at average sort of levels that we would see over the long term. So that's, if you think about having, say, 50% of your portfolio in equities over the long term, we're at 50% or just below. And that's because although we think that there's going to be increased volatility over the next month because of US presidential elections, news flow turning a bit more negative, there's still a lot of support in terms of liquidity from the central banks. And that's really what's been driving the market. So, if we look at the chart here, this is the returns of two asset classes over the past year. So the top one, the one in red, is the US stock market. And as you can see over the last year, it's actually in positive territory. And that's mainly driven by the tech stocks within the US stock market. So we don't think there's as much value there, but where we do think there is still some value left to be helping portfolios basically, is in some of the mid-cap names, particularly within the UK. So the green line here is the FTSE 250. This is medium-sized businesses within the UK. They tend to be driven by the real economy and what's going on, and they've still got room to recover. You know, they're not back to where they were at the start of the year. They're still down. We think there's value there. There's no immediate catalyst for them to rate higher, but it could just be that the value on offer comes through over time. The final reason why we remain, you know, long-term positive on equities is simply because there's so many people out there that have cash available to invest, and yet interest rates are going to stay a lot lower for longer. And I've got a bit of deja vu here because it's what we were saying back in 2010. But I think it's going to be a very similar scenario again. It would be very difficult for central banks to raise interest rates without causing serious knock-on effects. And indeed, the Federal Reserve has said that they're unlikely to raise rates for another 3 years. And all of this means that anyone sat in cash is not going to earn a lot. So we think there will be a continued demand for higher yielding investments, be they corporate bonds or even equities, given the dividend yields on offer. So we think that money flowing into equities will continue to help support the market over the long term.
In addition to what Daniel have just said, I would ask the new audiences to Rosecut webinar to visit our website and look at the third webinar, you know, how to invest through the recession, and why do we ever need to do that? The answer is, you know, if you look at the consumer inflation rate, it hasn't changed much, you know, for the past decade since the financial crisis. But if you look at the asset prices, be it, you know, real estate, land, you know, company equities or fixed income, everything has gone way up, right? So this is just a simple reason. There's too much liquidity, too much monetary supply in the market, and there's not enough assets around. Then the property price and, you know, the company equity price go up. So this is why, you know, maybe some of you who are familiar with the market feel nervous about the sharp fall back in March, and that's the reference point where Daniel said, you know, despite all that, the US market has recovered and trended higher, and UK market, some parts of UK market has not. So it's a real art and, you know, experience of be greedy when everyone else is fearful, and be fearful when everyone else is greedy. And this is actually a professional job called, you know, portfolio management. So we are sharing the market outlook just to let you have a sense of what's going on and our view, but we do not encourage active trading or you try to DIY a portfolio if you are not sufficiently experiencing this. This is usually where 99% of people lose money. So I just want to point it out to say, you know, if you want to get professional advice, medical advice, you go to see a doctor. Same thing here. You go to see a wealth manager, a portfolio manager. You know, you can afford an online free one like Rosecut without paying thousands of pounds for the service, and get a professional advice rather than trying to do it yourself. So this is super important.
So here's some additional resources that we have on our website to help give you information. And we've also included the Money Advice Service down there, which I believe is a government-run organization. So they also give, you know, some good educational material, and it's worth checking out.
We will send all these links in our follow-up email after the webinar as well. So that brings to the, you know, conclusion of the formal presentation. It's rather conversational to give you a flavor of the important things to consider pension versus ISA. And, you know, please do ask any questions that you have in mind. We have a list that we're going to go through now. And also here we will open the poll. And we would appreciate you taking just 10 seconds to click through 5 very simple questions, what you like, what you don't like, and what are the future topics. The reason why this topic was chosen was because it was #1 topic out of the previous 2 polls. So while you do that, let me go through the question list. The first one saying, are your seminars available online? How could I rewatch them? This is very straightforward. Go to rosecut.com, click on resources and magazine, and you can find not only the full recordings of all our previous webinars. This one will take a few days to go through compliance and appear, but the previous 3 are all there. And there are our monthly update and articles and stuff like that. Generally, we have received really good feedback from people in terms of how they like the quality and the depth of the webinars. Second question from Kevin, are there any changes that the government might make to pension or ISA allowance? Daniel, you want to sum it up?
I think on the ISA allowance, there's nothing on the horizon right now. We've not seen anything. If we look at the trend over recent years, they've actually increased that allowance. As I touched upon earlier, it was around £7,000 back, when I started 12 years ago. Now it's £20,000. I think that's because the government's keen to encourage people to put these provisions in place for their retirement. So that's why that's increased. There's always talk that the pension allowance might change. For example, the lifetime allowance has trended down over time. There's also, pretty much every year, someone says that the tax benefits to a pension might be changed and it might not be as generous. I've heard it for so many years now, I'm getting a bit skeptical. So I'll kind of believe that when I see it. Those are the only things that really come to mind at present.
Great. The next question from Chiara. If I leave the UK, can I keep my ISA as ISA or do I lose the tax benefit? So the answer to this is very straightforward, Daniel.
Yes, well, I think you can keep the ISA in place. Often what people do, the easiest solution is normally for them to sell up, close the ISA down and move it out. But that's not always the appropriate thing. So it does vary depending on people's circumstances, as you'd imagine. But yeah, you can no longer contribute to a new ISA. I think you can keep the one that's already in place. Yeah, but before doing that, I would reach out to us so we can double check that, as I've not come across that scenario recently.
Yeah, the rules changes every year, right? So if that happens, always check the up-to-date rule. Based on what we know today, you can keep your ISA account. There's no problem. It's just no more top up for the tax year that you turned non-tax resident. The next question, do you see the Bank of England interest rate going into negative interest? And if so, how would this impact cash ISAs? Interesting question.
It is, yeah. There's a lot of people, including myself, that are really apprehensive about the idea of negative interest rates. It's just my personal opinion, but it kind of feels like the system's really broken if we need to go that far. But the Bank of England, they are definitely looking at it. They're considering it. I don't know is the honest answer. I hope they don't do it. How it would impact cash ISAs, well, it's clearly not going to be helpful. I doubt that cash ISA interest rates would go negative because no one would bother with them. If it happens, it's clearly not positive because you'll get a lower return. I doubt that they would go negative on a cash ISA. What the Bank of England does, who knows anymore? Like the amount of stimulus they've done over the past few years since the 2008 crisis, you wouldn't have believed back then.
Yeah, that's another really important point, as we were mentioning, right? You think things are bad enough with such a low interest rate, it might go negative, and you've already seen that in Europe. And there was recently a big ISA provider, I can't just remember the name now. Usually they have 1.2 or 1.5% interest rate, and now they just have reduced it to 0.01, right? That's zero, basically. There's nothing there. And again, there's a lot of complaint in the market, but that's the macro situation we are in at the moment. So what is your view on the effects of Brexit on UK economy?
So I think if we look at the performance of different sectors and the currency markets, what we can see is every time the prospect of a hard or clean Brexit, depending on what terminology you prefer to use, we see that sterling sells off relative to the other major currencies, such as the dollar and the euro. We also see that other very domestically focused sectors, such as real estate, home builders, consumer discretionary to an extent, those sectors are the underperformers. So, you know, what the market's saying is that there would certainly be a negative impact from a hard Brexit. Now, that's the immediate impact. The longer term impact is less clear. What we might see is sterling weaken, and that acts as an adjustment mechanism. So it makes our exports cheaper, and it helps drive more growth going forward. It's difficult not to get political about it, to be honest. So I'm trying to stay quite neutral here. Short-term impact, to sum up, I'd say short-term impact is a hit to the UK economy. Longer-term impact, I'm actually more optimistic about. I think there's a lot of potential there if it's handled well. But that's further out, that's a couple of years away. I think we need to see what happens on the 15th of October to see what the chances are of a hard Brexit versus a Brexit with a sort of deal. If there is some sort of deal that the market likes, then I would expect to see sterling strengthen and the domestic stocks outperform, such as the UK property ETF, which we have in portfolios for a hedge against that very scenario.
I would provide perhaps a bit surprising answer to that question. You know, sometimes we are really consumed by the short-term political or economical whatever sort of big events. But if you zoom out, and like what we talked about before, your lifetime, let's assume, is 100 years, you are deemed to experience 10 to 15 economic cycles that all sorts of things happen, right? So it's not worth too much effort to really worrying about those political or economic or social events and not investing by holding a lot of cash. Because if you look at the past 100 years, you've got, you know, 2 world wars, and you have the Great Depression, and all these kind of things happen. Yet, you know, the financial market has increasing value in tenfolds at least, right? So we would say for your lifetime retirement planning, don't fixate it on a certain political event such as Brexit. You know, countries broke down and, you know, reform and all over the years, and that doesn't stop you from planning for your retirement. There's a really interesting study I saw during my time at Credit Suisse. They looked at all the political events in the past 100 years and realized the impact of political events on financial market comes to 0 after 18 months after the political events finished. So, you know, of course, history does not always repeat itself, but using that as comparable, by the time the whole Brexit, you know, drama settles, 18 months later, it may have 0 impact on the financial markets. So these are important things to care for, but it's less correlated to your lifetime investment than it seems. Moving on to the next question. Why should an investor choose Rosecut over anyone else? For instance, Response. Very good question here, right? Like I would say, first of all, Response is a long-established wealth manager, you know, with 150 years of history or something like that. I happen to have an ex-colleague there that I'm very familiar with the business. So they are a reputable provider. With Rosecut is a company that's barely 2-year-old, right? We are a fintech company, but both companies are the same in terms of we are subject to the FCA regulatory requirement. Your money invested with either of us will be in a separate client account that does not go into the balance sheet of either company. So the protection level is the same. Doesn't matter you choose the 150-year-old company or a 2-year-old company. Second point I would make is that what you would compare then is the investment return and as well as the service you receive. So investment return in Response, it depends on which investment manager you choose, their style, their return, and whether that's compatible to you. And Rosecut offers a very efficient and good return portfolio that is private banking quality and have been beating the private banking benchmark called ARC by more than 4% since inception, right? So if you pull the investment return out, you can actually compare apple to apple on the same risk level. The third thing I would say, what I consider Rosecut is better than Response is, of course I'm gonna say that, is we are much more digitally efficient, and it just saves you time. Time is money. You're gonna wait for at least a couple of weeks after you fill in a paperwork of more than 40 pages with quite a few signatures for your investment manager at Response to process it, maybe ask you a few more questions while they do that. So end to end, when you decide to open an account with Response to your money deployed in the market, it takes about a month. If you don't have a high-risk passport like Russian or Chinese, right? That's just how the regulatory system works here. With Rosecut, the time you need to spend on getting your account opened is 10 minutes end to end. And then just a couple of days for you to remit the cash and deploy it into the market. So we would say a digital company like ours has a lot of efficiency gained from our setup and our, state-of-art tech stack, to be honest. And I wouldn't comment on certain specific questions, but I would, certain specific companies, but I would say our triple layered security is one of the best in the industry, if not the best, compare across all the private banks and wealth managers. So that's my answer to that question.
If I could just add to that, Q, as well.
Yep.
In terms of the investment performance, if anyone is curious about the numbers, it's the end of a month. So I'll be updating our usual fact sheets with the latest performance numbers. So if anyone does want to see those, please just drop us an email. We can send them back, give you more information that way.
Cool. The next question, can you please confirm you can use ISA to invest like an angel and enjoying schemes like EIS? I think the question is mixing up a couple of things here. So first of all, ISA, as we were saying on the page, you have, cash ISA and investment ISA, and in investment ISA, there's all sort of like, innovative finance ISA and stuff like that. But typically the provider will tell you what the type of ISA it is. And typically most of the people use stock and shares ISA, basically investment ISA, to invest into public market, which is listed stocks and fixed income. Now, if you want to invest as angel, there are two types of different schemes, SEIS and EIS. So, depending on the different types of companies and how old and what kind of, turnover they have, they can qualify for SEIS and then EIS. For example, Rosecut have SEIS investors and EIS investors, but that's completely separate from the ISA wrappers. But as an individual, you can have multiple ISA accounts with multiple providers. You can have multiple investments into different startups who qualify for EIS and EIS schemes. So please do check, with those private companies, if they have SEIS or EIS sort of qualifications that are approved by the taxman. This is completely separate, but the similarity between ISA and those guys is that you enjoying certain level of tax benefits. They give you, a portion back of your income tax that you already paid as a percentage of the SEIS and EIS investment. But just as a reminder, that's highly risky compared to public markets because you are investing into young startup companies that is not public traded, meaning poor liquidity. So if you go to the Rosecut platform and plot out all these kind of things on your personal wealth balance sheet, we will show you this is a illiquid portion and what your overall liquidity ratio is if you are going to do this. A typical mistake many tech entrepreneurs make, for example, is they put a lot of their cash into angel investment, and that's not enough cash in the financial assets to generate stable income or return for them to retire. So to manage the right balance between your public market investments versus private market investments is crucial here. And this is, you know, the liquidity ratio we are talking about. I think that's all the questions I have here. Daniel, have you looked at separate other questions or?
Nope, I've not seen any more, but I'm sure if anyone does have any, they know how to get in touch with us. And yeah, please do so.
Yes, so our website is rosecut.com, and if you got any questions, please send to contact@Rosecut or give us a call if you prefer to be old-fashioned and talk to one of the humans at Rosecut. So it's really lovely to have all of you today here with us again, and we'll hopefully see you again in our October webinar.